Investing is a great way to increase your wealth, but it's also a way to protect the money that you've already made. In this video, we'll look at 6 investing mistakes that beginners make that can lose them lots of money in the long run. Mistake number 1, not getting started early. The earlier you start investing, the more money you make. This is because of something called compound interest. Basically, interest on interest. For example, investing $10,000 with a 7% return would earn $700 in the first year, but in the second year, that extra interest will itself earn interest, giving you a total of $750. While an extra $50 might not seem like a big deal, over the course of several decades, the effects of compound interest can be staggering. After 40 years, that initial investment of $10,000 is now worth $150,000. The interest alone on that would be more than what you put in the first place. It gets even better when you consider regular contributions, rather than just the returns in the initial $10,000. For example, if you continue investing $10,000 a year, starting at 20 and going until you're 60, you'll end up with over $2 million. If you start at 30, that number will instead be a little under $1 million. It's worth noting here that we're not accounting for the effects of inflation, but either way, the difference is still substantial. That being said, $1 million is still a lot of money. Getting started now is better than wasting time regretting not starting earlier. With all that being said, investing is not something that you should rush into. If you have a lot of debt, especially with higher interest rates, you might want to put off investing until you pay that down, since debt compounds too. You should also have an emergency fund, maybe 6 to 12 months of expenses saved, so that any unexpected problems don't force you to sell your investments and lose money in the process. Mistake number 2, trying to time the market. Since the value of the market can change a lot in a short time, a lot of investors try to anticipate drops in market value. This is known as timing the market, where you either wait to begin investing until after a market crash, or where you sell your investments while they're worth more, then buy them back afterward when they're presumably cheaper. This strategy doesn't work, for several reasons. First, it's been demonstrated time and again that trying to predict what will happen to the market is impossible. There are way too many variables to consistently get this right. Even financial experts can't do this, as we'll talk about shortly. Investment should be a long-term commitment. Moving money in and out of investments will stunt their growth by losing out on compound interest. Doing this can also incur fees and penalties, which can stack up over time. There's a popular quote when it comes to investing. Focus on time in the market, not timing the market. In the long run, the value of the market has always increased. So making consistent contributions to your investment portfolio during good times and bad should counterbalance any volatility in the short term. Mistake number 3, not diversifying enough. Buying stocks for individual companies can be risky, especially for beginners. This is why we'd recommend you get started with what's called an index fund, a type of mutual fund designed to track a financial market index, like the S&P 500. Instead of buying a small piece of a big company, you're buying a lot of really small pieces of many companies. By investing in an index fund, you're not putting all of your eggs in one basket. You can even buy into several different index funds to even further diversify your portfolio. While this may limit your return on investment, it will significantly reduce the risk as well. Now, so far in this video, we've only really talked about buying stocks. However, we can diversify beyond stocks and protect against a stock market crash. There are many other options, but one of the most common alternatives to the stock market is bonds. When you buy a bond, you're basically lending money to the organization that issues it. After buying it, you receive interest payments, and then you get the initial amount of money back in full when the bond's term ends. Government bonds in particular are considered an incredibly safe investment, though generally come with a lower return. Of course, stocks and bonds aren't the only means by which you could diversify your portfolio. Many people invest in real estate, for example. However, because of the nature of real estate, it's less easily traded, which makes diversification a bit more complicated. Overall, just starting with an index fund is a perfectly good approach to diversification for a beginner. However, different investors have different appetites for risk, so there's no one-size-fits-all for diversification. If you're interested in being more active in the management of your portfolio, be sure to consider your asset allocation and plan accordingly. Mistake number 4, trusting other people with your money. Be very careful when dealing with financial professionals. There are no doubt advisors out there who give good advice and can genuinely help you to build your investment plan. However, as soon as someone mentions something like an actively managed mutual fund, run. For one thing, it's very difficult to beat the market, meaning getting returns that are consistently above those of one of the stock market indices, like the S&P 500. Very few investors manage it over an extended period of time. On top of this, actively managed investments are really expensive to maintain because of the way that fees are structured. Sure, a 1% fee doesn't sound like much, though it's worth mentioning that many mutual funds have fees higher than that. But remember that investing relies on compound interest. Even if the mutual fund gets the same returns as a low-fee index fund in the long run, that 1% fee applies to the total value of your investment, meaning that a 7% return becomes a 6% return. And that 1% difference adds up a lot over the years. Finally, actively managed funds tend to exchange assets more frequently. Even though this is all happening behind the scenes, these exchanges trigger capital gains tax. Speaking of which, mistake number 5, not considering taxes. Taxes affect investment negatively because they chip away at compounding gains over time. Depending on how much you make and where you get your money from, this effect can be anywhere from non-existent to substantial. In addition to careful timing and planning, you should strongly consider contributing to a tax-advantaged account. The most common are the IRA, opened by individuals, and the 401k, which are run by companies on behalf of their employees. Traditional accounts of these types are tax-deferred, meaning that you don't pay income tax on the money you contribute. You will ultimately have to pay it when you take it out, though. Meanwhile, those accounts with a Roth in their name are tax-exempt, meaning that you have to pay tax on the money you put in, but there's no tax later on. In both kinds of accounts, no taxes are ever assessed on any investment income, including capital gains. However, you can only contribute a certain amount of money to these accounts every year, and there are often penalties or restrictions involved in withdrawing money from them before a certain age. Generally speaking, using a Roth account is better when your income is low, so that you can pay low taxes now, while using a traditional account is better when your income is high, so that you can avoid high taxes now and pay lower taxes when you're retired and your income is presumably lower. You can even have both, and contribute to one or the other depending on your tax situation that year. Mistake number 6, having unrealistic expectations. The last mistake the beginning investors make is that they overestimate just how much money they can get through investing. It's true that regular contributions and compound interest really stack up over time, but between taxes, expenses, and mistakes made along the way, the amount that you end up with will largely reflect the amount of money you set aside on a regular basis. Be sure to do your research here, and determine what kinds of returns you can realistically expect given your appetite for risk. As we mentioned earlier, don't forget to take inflation into account, since inflation compounds just like interest, just in the opposite direction. In addition, consider that your appetite for risk will decrease as you approach your retirement age. A market crash wiping out 30% of your retirement savings doesn't matter too much when you're 35, since the market will have time to recover, but it could be crushing when you're 60. As such, investors are traditionally advised to move their assets from high-risk, high-yield investments like stock to low-risk, low-yield investments like bonds as they age. Investing can be complicated, but it doesn't have to be hard. Keep these potential mistakes in mind as you continue learning about investment, and you'll be off to a great start.